Richard Donchian. The father of trend following. Trend following or trend trading is a trading strategy according to which one should buy an asset when its price trend goes up, and sell when its trend goes down, expecting price movements to continue. There are a number of different techniques, calculations and time frames that may be used to determine the general direction of the market to generate a trade signal, including the current market price calculation, moving averages and channel breakouts. Traders who employ this strategy do not aim to forecast or predict specific price levels, they simply jump on the trend and ride it. Richard Donchian was born in Hartford, Connecticut, in September 1905. He attended public schools in Hartford, the Taft School in Watertown, Connecticut, and graduated from Yale University in 1928 with a bachelor's degree in economics. Upon graduation, he entered the family's Oriental rug business. Although he appreciated studying about and collecting Oriental rugs, he became more interested in the financial markets after reading the book about Jesse Livermore, Reminiscences of a Stock Operator. After suffering personal financial losses during the market crash of 1929, he began his study of technical analysis, believing that only the chartists made sense in money. While continuing to serve as a vice president of the Samuel Donchian Rug Company, he became a securities analyst and account executive with Hemphill, Noyes & Company in 1933. During World War II, he participated in the invasion of Sicily and later served as an Air Force statistical control officer in the Pentagon. After the war he returned to the world of investments as a private investment advisor and economic analyst, remaining self-employed until 1960. In 1948 his focus changed from securities to the trading of commodities. He created Futures Incorporated, a pioneer publicly held commodity fund, based on the principle of diversification, an idea new in this field. He was later dubbed the father of modern commodities trading methods, having developed a technical trading method called trend following, which presupposes that commodity prices will move in long sweeps like bull and bear markets. He used a mathematical system based on moving averages of commodity prices. During this period, he authored numerous articles on both securities and futures trading. In 1960 he became associated with Hayden Stone Incorporated, as Director of Commodity Research. From then until his death on April 24, 1993, he was associated with the various configurations of Hayden Stone and Shearson Lehman Brothers, now Smith Barney, and was a senior vice president. Also in 1960 he became responsible for writing a weekly technical newsletter entitled Commodity Trend Timing, which he continued to author for 19 years. In 1963 he was awarded a Chartered Financial Analyst degree from the Institute of Chartered Financial Analysts at the University of Virginia. In 1970, a booklet entitled The Trader's Notebook was published by Dunn & Hargit's Financial Services in Lafayette, Indiana. The best-known commodity trading systems of the day were computer-tested and compared. The final conclusion of all that research was that the most successful of all the systems tested was the 4-week rule, developed by Mr. Richard Donchian. A later article by Lukac and Burson in the Financial Review, November 1990, published the results of a more extensive study done on data from 1976-86 that compared 23 technical trading systems. Once again, channel breakouts and moving average systems came out on top. The 4-week rule is used primarily for futures trading. The system based on the 4-week rule is simplicity itself. 1. Cover short positions and buy long whenever the price exceeds the highs of the 4 preceding full calendar weeks. 2. Liquidate long positions and sell short whenever the price falls below the lows of the 4 preceding full calendar weeks. The system, as it is presented here, is continuous in nature, which means that the trader always has a position, either long or short. As a general rule, continuous systems have a basic weakness. They stay in the market and get whipsawed during trendless market periods. However, trend-following systems do not work well when markets are in these sideways, or trendless phases.
Donchian's trading rules.
Beware of acting immediately, on a widespread public opinion. Even if correct, it will usually delay the move. period of dullness and inactivity, watch for and prepare to follow a move in the direction in which volume increases. Limit losses and ride profits, irrespective of all other rules. Light commitments are advisable, when market position is not certain. Clearly defined moves are signaled frequently enough to make life interesting, and concentration on these moves will prevent unprofitable whipsawing. Seldom take a position in the direction of an immediately preceding 3-day move. Wait for a 1-day reversal. Judicious use of stop orders is a valuable aid to profitable trading. Stops may be used to protect profits, to limit losses, and from certain formations such as triangular foci to take positions. Stop orders are apt to be more valuable and less treacherous if used in proper relation to the chart formation. In a market in which upswings are likely to equal or exceed downswings, heavier position should be taken for the upswings for percentage reasons. A decline from 50 to 25 will net only 50% profit, whereas an advance from 25 to 50 will net 100%. Buy strong acting, strong background commodities and sell weak ones, subject to all other rules. Moves in which rails, transportation, lead or participate strongly, are usually more worth following than moves in which rails, transportation, lag. A move, followed by a sideways range, often precedes another move of almost equal extent in the same direction as the original move. Generally, when the second move from the sideways range has run its course, a counter move approaching the sideways range may be expected. Reversal or resistance to a move is likely to be encountered when reaching levels, at which in the past, the commodity has fluctuated for a considerable length of time, within a narrow range, or on approaching highs or lows. Watch for good buying or selling opportunities when trend lines are approached, especially on medium or dull volume. Be sure such a line has not been hugged or hit too frequently. Watch for crawling along or repeated bumping of minor or major trend lines, and prepare to see such trend lines broken. Breaking of minor trend lines counter to the major trend gives most other important position-taking signals. Positions can be taken or reversed on stop, at such places. Triangles of ether slope may mean either accumulation or distribution, depending on other considerations, although triangles are usually broken on the flat side. Watch for volume climax, especially after a long move. Don't count on gaps being closed, unless you can distinguish between breakaway gaps, normal gaps and exhaustion gaps. During a move, take or increase positions in the direction of the move at the market the morning following any one-day reversal, however slight the reversal may be, especially if volume declines on the reversal.